My name's Hayden Griffiths and I work for JBWere in the Investment Strategy Group, which is the research division of the firm really. One of the key areas that I focus on is asset allocation, which from an investor's perspective in terms of a diversified portfolio is all about how you are broadly invested across the different asset classes of cash, bonds, equities and alternatives, which are usually private equity and hedge funds, and the compositional mix between onshore, New Zealand and Australia, and further afield in global exposures. We run a number of model portfolios, in fact 4, to try and canvass the full spectrum of investor risk profiles. We have a very conservative asset allocation, which is predominantly allocated towards cash and fixed income, and that moves right through to an aggressive profile which is allocated predominantly to growth assets, being mainly equities and shares. On top of this, we've got a tactical asset allocation overlay, and that involves JBWere making recommendations for portfolios to tilt their exposures away from their chosen benchmarks for each of the asset allocations that they have. And that's on the basis of JBWere's view on the markets that underlie each of those asset classes. Now recently we've moved to be further underweight New Zealand equities, and back in March we actually went from being neutral to modestly underweight, and that was on the basis of the market as we saw it then not being as conducive for being able to for active managers to be able to deliver outperformance in the market. That is, to be able to compile a portfolio selecting winners from losers within the equity securities available here to outperform the NZ50 index. Actually, the situation in global equities is a reverse, and at the time that caused us to go from a neutral position to a modest overweight back then. Rolling forward to last week, when we went further underweight New Zealand equities, that was on the basis of an additional 4 factors really. Looking at the first one, which is valuation. And it doesn't really matter what valuation measure you choose to use, whether it be price to book, price to cash flow, price to earnings, or even dividend yield. The New Zealand market is in a state of stretched overvaluation, more so than its sister market in Australia and further afield in global equities. Now, while valuation in isolation isn't a very good predictor of short-term performance, in fact, overvaluation has been a theme in equities globally and locally for a few years now. It is a very good determinant of returns longer term, 5 years or more. Nonetheless, in the short term, valuation gives us some perspective and appreciation for how much prices could potentially adjust, in this case downward, to something that we would consider being fair value on a historic basis. So that's one factor just to consider. The second one is that the New Zealand equity market and its sensitivity or vulnerability to rising bond yields. The New Zealand market here for equities has predominantly been seen as a high income yielding market by way of high payout ratios. And in a world which we've had for the last few years with low interest rates, that's attracted the attention of offshore investors here, and the local market has benefited from that investor interest. However, now we're at a juncture where we think that bond yields are on a cusp of rising for the remainder of this year and into next year, mainly on the back of synchronised growth now emerging out of the global economic regions of the US and Europe in particular. And more recently, from what was concerted talk from the major global central banks around not only their desire to move away from very easy monetary policy to more normalised policy settings, but now they've got a willingness to do so. And those easy monetary policy settings that are in place at the moment are largely responsible and have placed a very solid prop under global equity and other asset pricing. This move from central banks marks, I guess, their expectations towards higher inflation, and with that we would expect bond yields to rise accordingly. We've seen a taste of that already since the announcements, and that will disproportionately impact upon the New Zealand equity market. The third element to consider is around what investors are being compensated for in terms of the risk that they face when investing in risky assets and equities. And this is another global phenomenon at the minute. There's not a lot of compensation in the prices that investors are paying up for. And we think that's a particular issue for the New Zealand equity market in light of the looming general election and the uncertainty around that in September. So the next couple of months we will see uncertainty start to come to the fore around that event. Okay, the fourth and final factor is really around earnings growth in the New Zealand equity market. We have New Zealand equity market and its compositional mix in terms of the underlying corporates. While not an exact representation of the New Zealand economy as a whole, the two nonetheless are quite closely correlated in terms of one affecting the other. When we look at the New Zealand economy, it's enjoyed robust growth for a few years now, and we're now getting to the point where it's starting to butt up against some capacity constraints. For example, in the areas of labour markets, in the banking system, in terms of banks being able to get regulatory capital from term deposits in particular to further extend credit and loan growth. And then we've seen very strong immigration also in the last few years, and that's started to put strains and pressures on the infrastructure, particularly in the Auckland area, around transportation, roading, schooling, housing. So there's a number of elements that are pointing to the New Zealand economy starting to reach capacity, and that in turn sets a limit for further surprises on the upside to economic growth. And we think those conditions carry over to some extent to New Zealand equities in limiting the upside potential surprises for earnings growth. So in summary, we've got those five elements: a deteriorating environment for active management, being able to outperform the market as a whole, overvaluation, a sensitivity or a vulnerability to rising bond yields, the fact that investors really aren't, we believe, being compensated appropriately for the uncertainty around the elections in September, and finally, somewhat of a cap on the upside surprise potential for earnings in the New Zealand market from here. Putting all those together, it just causes us to take stock and exercise a degree of caution with respect to investments in New Zealand equities, hence our underweight extension on that. If you'd like to find out more detail about our tactical asset allocation views, please refer to our monthly publication, which is the Investment News. We updated and published that recently last week. If you have any questions, please don't hesitate to call and contact your financial advisor here at JBWere. They will be too happy to help. And hey, thanks very much for listening in. I hope you have a good day. Goodbye.